A very good morning, friends. So I hope everybody is doing good. And I think finally the day has come where we're going to do the practical consolidation in terms of Ind AS 110. In the previous two classes on consolidation, we have learned the scope of the standard, the cases where consolidation is optional, and the cases where consolidation is not required to be done, mandatorily prohibited in terms of doing any consolidation. Then we also looked into the principle-based assessment, that how do you decide that there is a control. And we saw two situations where the control assessment is done. One is which is based on voting rights, and the other is which is based on decision-making rights, where it was a case of a fund manager. So now my focus today is going to be to teach you the consolidation technique. Now, I don't want to scare you early in the morning. But let me tell you that I am going to give you a certain technique which might contradict with your technique, what you've done at the intermediate level. So please learn with a very open mind. And trust me, the technique is going to be very easy, because in questions which are going to be complicated as well, you'll easily be able to crack this. We'll do a couple of questions practice as well. I am carrying with me a lot of questions which are there in the examination questions as well. So we'll be doing a lot of questions to give you a good umpteen practice as well, so you get a good hold on the consolidation. And we're going to start from the very scratch, the process of consolidation. So whether you've done it well enough at the intermediate level or not doesn't make a difference to me. But my next, I would say, around 45 minutes or so is going to be very crucial. I would say in the next 45 minutes or 1 hour is going to decide the fate of the consolidation technique. So please very carefully, appreciate the concept and learn the concept in the next 45 minutes to 1 hour, because this will be a base, a foundation to my technique. So let's begin with the journey, and I am going to start with a very basic example on consolidation. So I am coming to the concept of the consolidation technique. I am coming to the consolidation technique. And this consolidation technique is called a full consolidation. The consolidation technique is called a full consolidation, because as per Ind AS 110, the consolidation is always full when you get a control over a subsidiary company. So what I'm going to do, I will take one example and I will run this example in 4 different cases. Almost, you can say, a comprehensive permutation combinations of cases. As I proceed with the example, I'm going to make some T-shaped balance sheets only for the ease of convenience. So I'm not considering any proper formatting as of now. The idea is only to give you a basic conceptual clarity. There might be a few things also which I would intentionally assume as well. No worries, I'll pinpoint them as I proceed. So let's start with, first of all, a case number 1. I'm starting with a case number 1. What is my case number 1? Let's say a holding company acquired in the subsidiary company 100% stake. And I am going to make a consolidated balance sheet on the date of acquisition itself. My first case is focusing that there is no NCI. Mind the facts carefully. My first case is focusing that there is no NCI. I want to keep a 100% stake, and I'm going to make a consolidated balance sheet on date of acquisition itself. Second case, I'll introduce an NCI. So the first case is no NCI. That is the key focus, and the consolidation on acquisition date itself. So let me just take some arbitrary figures, and let's take the balance sheet of the holding company and the balance sheet of the subsidiary. So let's say this is the balance sheet of the holding company on the date of acquisition. And let's say this is the balance sheet of the subsidiary on the date of acquisition. And I'm going to make a consolidated balance sheet based on this. So this is going to be my consolidated balance sheet, which of course I'll make later. So let me just assume some arbitrary figures for the purpose of explanation. Let's consider we've got non-current assets. There are current assets. There is equity share capital. There is other equity, and there is current liability. Here also we've got non-current assets, but we'll also have the investment in the subsidiary, and there is current assets. Then there is equity share capital, there is other equity, and there is a current liability. Let me just assume some figures. Let's say this is 200, and let's say this is 100. Let's say this is 50, and equity share capital, let's keep it as 100. And let me consider the other equity as a balancing figure. I guess that works out at 150. So the total side is coming to 300. Perfect. Let's consider the non-current assets to be 500. The investments, let's keep it as 300. The current assets is 200. Let's consider the equity share capital to be 200 and the current liabilities 100. And let's keep this as 700. I'm just taking some arbitrary figures. That's it. So this is the balance sheet of the parent and the subsidiary. Now, watch my analysis very carefully. Watch the analysis very carefully. I am now going to give you some inputs. Please analyze this very carefully. I'm first of all looking at the fact that the parent acquired 100% stake in the subsidiary at 300. This is like a purchase consideration. And if you recall Ind AS 103, please mind every word carefully. If you recall the concept of Ind AS 103, when you were calculating a goodwill, you were comparing the purchase consideration plus the NCI, and you were comparing it with the net assets on the date of acquisition, or yes, sir. So I'm going to do the same exercise. I am comparing the purchase consideration. The investment in the balance sheet is like a purchase consideration. And if you look at the net assets, there are two alternative ways of calculating a net assets. One alternative is that I take all the assets minus liability. Or the other alternative is I take the sum total of the share capital and the other equity. Both ways I can get the net assets. I am going to prefer considering so far the net assets as the sum total of the equity share capital and the other equity. This is what you can call as the net assets on the date of acquisition. So either you consider the assets minus liability, or you consider the sum total of this. It's one and the same thing. So you get the net assets on date of acquisition. And my presumption is that this is all at a fair value. So I'm also assuming that this net assets at the acquisition date, let's assume the book values and the fair values are same. So I think I'd like to get some inputs from your side as well. So you know the purchase consideration is 300 with no NCI, and you compare this with the net assets. Would you like to tell me what is the goodwill or the bargain purchase gain? Let's get this from your side. So I'm just working on the comparison of the goodwill. We can just make a small working note as well to calculate the goodwill. So what do you say is the goodwill? You take the purchase consideration, that is 300, and you add the NCI, which is not there, and you compare this with the net assets on the date of acquisition 250. So we get a goodwill which is to the extent of 50. I guess everybody would agree with me on this. Perfect. So what I'm going to do, I'm going to put this goodwill in the balance sheet out here in the consolidated balance sheet. I'm going to put this goodwill 50. Trust me, I'm done. Trust me, I am done with the consolidated balance sheet. You know what is a consolidated balance sheet? A consolidated balance sheet is simply you add the two balance sheet line to line. As simple as that. The consolidated balance sheet is simply adding assets to assets, liabilities to liability. Now let me ask you a mathematical question because you need to be convinced with the fact. If you merge the two balance sheets, right now you've taken a net impact of these items. So will these items appear in the consolidated balance sheet? What do you say? A consolidated balance sheet means you're going to add all the items one to one. Now what you have done at this stage, you have taken the net impact of these three items. If the net impact of these three items is appearing, do you think these three items should appear in the consolidated balance sheet on a mathematical level? And that's right, of course not. So this will not appear in the balance sheet. This will not appear in the consolidated balance sheet. Now you're free to add one to one. Let's add the items now. So I'm just going to add items to items. NCA 500 and 200, that comes to 700. Investments will not appear in the balance sheet, gone. Let's add the current assets to current assets, and that is 200 plus 100, that makes it 300. I think my asset side is done. Let's go to the liability side, and equity share capital, no additions, because this will not appear in the balance sheet, so this appears at 200. Other equity also no aggregation, so other equity also appears in the balance sheet at 700. And as far as the current liabilities are concerned, you add the current liabilities, that is 150. Let's see, is the balance sheet agreed on this or not? Let's see, is the total of the balance sheet match? That's I think 1050, and I think this is also 1050. My consolidated balance sheet is ready. Superb. I hope, friends, you got the technique right. I don't think so there would be any concern so far. I have not done anything technical. What I all did was I compared my investment, which is a purchase consideration, and compared it with the net assets, assuming the book value, fair values are common. There was no NCI. I got a goodwill. So the goodwill appeared as a separate line item. And then after that, I just aggregated the assets and liability and made my console. Superb. Now, friends, I want to make some analysis out here as well. I want to look at the deeper figures as well, because there is something which you need to appreciate at this end. It's going to be helpful to me in the coming sessions. Let me now take it further and let me just analyze. I want to compare this balance sheet of the parent company and the consolidated balance sheet on one-to-one basis. And by making this comparison, I want to identify what is the technical difference between the two balance sheets. I'm going slow because you can analyze what I'm saying. I want to compare the balance sheet of the holding and the consolidated balance sheet on one-to-one basis, and I want to understand that what exactly has happened in the consolidation process. Let's do. This goodwill was not appearing in the holdings balance sheet. That is one addition. This non-current assets has got increased by 200. The current assets has got increased by 100. And of course, the investment has disappeared on the asset side. There is no change in the share capital. There is no change in the other equity, and the current liabilities also is increased by 50. Now, I'm going to make a statement at this stage, and you need to vouch me for this. If you consider the change in the net assets, the additions in the net assets, what is the addition in the net assets? This is 300 minus 50. The net assets is to the extent of 250. So we have added the net assets to the extent of 250, and there is an addition in terms of goodwill that is 50. The sum total of this is 300. and this is equal to the investment value as well. So can I make a statement that investment is being replaced by the goodwill and the net assets? Vouch me carefully. I made a one-to-one comparison of the parent and the consolidated balance sheet, and I could see that there has been an increase in the net assets to the extent of 250, and there has been a goodwill appearing as a separate line item. The investment got replaced by the goodwill and the share in the net assets. Agreed? Wonderful indeed. So I think let me also put this down as well. So we can say in the consolidated balance sheet, investment has been replaced. Investment has been replaced by net assets plus the goodwill. So I think this would be correct to say that investment is being replaced by net assets plus a goodwill. Right, friends, I think I am done with the case number 1. I'll just quickly give you the synopsis, because as we are going to go to the next step, the next case, you might see some more additions coming in. So let me just quickly consolidate the picture. What I did, I took the balance sheet of the parent, I took a balance sheet of the subsidiary with no NCI and the consolidation on the acquisition date. The only thing which I did was I made a calculation of the goodwill based on Ind AS 103. Mind you, I made my calculations of goodwill based on Ind AS 103 because goodwill is calculated on acquisition date. So I compared my PC, which is the investment in the balance sheet of the parent. There was no NCI, compared it with the net assets, where instead of taking the assets minus liability, I preferred to consider the sum total of the equity. Assuming the book values, fair values were common, I got my goodwill of 50, and I showed this goodwill as a separate line item in the balance sheet. My consolidation, I said, is nothing but it's a sum total of the two balance sheets. Now, when you've taken a net impact of these 3 items as goodwill, these 3 items cannot appear in the balance sheet. And I want to make some strong statements at this stage. Investment in subsidiary will never ever appear in the consolidated balance sheet. Equity share capital of the subsidiary would never ever appear in the consolidated balance sheet. Other equity of the subsidiary as of now would never ever appear in the consolidated balance sheet, because the investment, the equity share capital, and the other equity is presented as a net figure, which is a goodwill in the balance sheet. So 3 items would never be seen in the consolidated balance sheet as of now. The investments will not be seen in the console. The equity share capital of the subsidiary will not be seen in the console. The other equity of the subsidiary will not be seen in the console. And then we made the analysis that in terms of consolidation, what is being done, investment is got eliminated, and what's taken in the place is goodwill and the net assets. Investment stands replaced by the net assets and the goodwill. I hope, friends, I am 100% clear, not even 99, 100% clear. Give me a thumbs up if you're 100% clear on the concept. Superb, crystal clear, that's wonderful indeed. Now we are going to go to the case number 2. And I'll develop all my rules and the principles of consolidation based on the 4 cases. Then I'll give you all the detailed steps. What do you need to do in terms of consolidation? Then I'm going to come to the bigger kind of questions. Now let's go to the case number 2. Now let's go to the case number 2, where I am considering holding is got in subsidiary. Let's consider 90%. So I am considering there is a 10% NCI. But I'm going to make a consolidated balance sheet on the date of acquisition itself. I'm just making a minor change. And the minor change which I've done, I am just introducing NCI in the previous case. So let's take the same balance sheets as case 2. So let's consider the same balance sheets of case number 1. I'm considering the same balance sheets which I gave you in case number 1, except that I'm introducing NCI. Now watch this carefully. Let's make the consolidated balance sheet of the parent company. So we are making the consolidated balance sheet on the date of acquisition itself. Let's get back. Now let's make the calculations again. Now when you're going to calculate the goodwill, your goodwill is going to depend upon whether NCI is taken at a fair value or the goodwill or the NCI is taken at PASNA. I am not giving you any information about NCI at a fair value. So I'm going to consider my NCI based on PASNA, that is a proportionate share in the net assets. Because we know that as per Ind AS 103, you can consider your NCI at a fair value or you can consider NCI at a PASNA. But in this case, I'm taking a presumption that I am going to consider my NCI at PASNA. In the absence, I am considering my NCI at proportionate share in the net assets. So let me first calculate my goodwill. First, I'll calculate the goodwill. So I take the purchase consideration, same 300. By the way, please do not match results later, because if you've acquired a 100% stake at 300 and even a 90% stake at 300, I know that's not logical. I know it's not logical. Later you'll say, sir, in the case number 1, you said you paid 300 for a 100% stake, and in the case number 2 at 90%. Or let's even take it as 80%. What's the big deal? Let's do one thing. Let's make it as 80%. So I'm going to take this as 80. I know I am taking 80%. So technically speaking, the value of the investment cannot be same. So what? I'm not bothered on that. So don't get, thought processes triggered that why is this still 300? I mean, I'm just a figure. So let's not consider that you paid the same money for 80 or did you pay the same money for 100. Let's not compare. So the purchase consideration is 300, and to which I am going to add my NCI, which is going to be taken at PASNA. So what was my net assets? My net assets is 250. So let me take 250 is the net assets into 20%. That is the NCI, and that works out at 50. So this is to the tune of 350. And you compare this with the net assets, and when you compare this with the net assets, that comes out to 250. So we get a goodwill to the extent of 100. Now I know many of you would later revise and say, sir, if the goodwill was 50 for a 100% stake, it should be 80% for a 80% stake. That means 40. That would be true only if you change this PC to a proportionate figure. Let's just do that for understanding. If you paid 300 for a 100% stake, for an 80% stake, technically you should have paid 240. So 240 plus 50 makes it 290. 290 minus 250 will make it 40. That would be perfect maths. But I'm not interested in changing the balance sheets in this case. But if you feel that this is going to create confusion for you, I can change the balance sheet, but then I have to make some adjustments in the current assets in that case. I think we can manage it with these figures. So please later do not make any analysis that why this goodwill is not turning out to be 40. Because since I've not changed the cost of the investment, because investment technically should have been 240, then I would have got a goodwill of 40. But since I did not change the value of the investment, do not compare case 1 and case 2 goodwill. I hope I'm clear. Okay, let's go further. So this goodwill is now going to appear to the extent of 100 out here. I want to do some more maths out here now. I'm just thinking that alternatively, can I simply compare 300 versus the share in the net assets? Instead of comparing the PC plus NCI, why not consider the PC versus share in net assets? Because when you take the NCI at the share in the net assets is as good as taking 80% of the net assets. So when you take 80% of the net assets, you'll again get the goodwill 100 itself. Now let me make a statement, friends, to you on a mathematical level. In my second case, I compared 300 versus 80% of this. In my second case, I compared 300 versus 80% of this. 20% is not taken in this comparison. So will that 20% appear in the balance sheet? Yes, as an NCI. Get this clear. You compared 300 versus 80% of this. The net impact is goodwill. The remaining 20% should appear in the balance sheet because everything is not eliminated. You made a comparison of 300 versus 80% of this figure. So the remaining 20% appears as an NCI in the balance sheet, and that is to the extent of 50. So the only new addition which has come in case number 2 is the NCI. Trust me, rest I can copy the balance sheet. Rest, the consolidation remains the same. Whether the parent has got a 100% stake or an 80% stake, the consolidation will always remain full. So in this case, let me copy this. NCA is supposed to be the non-current assets is 700 and the current assets is 300. This is line to line. The equity share capital, other equity also remains 200 and 700. So no changes in the equity share capital or the other equity as well. And even the current liabilities would remain the same. That's 150. So now let's see, is the balance sheet agreed or not? 1100, I guess 1100, the balance sheet is agreed. Did you get the case number 2 also very clear? I just added the element of NCI in the case number 2. That's it. So what we did, we had a goodwill also and we had an NCI also appearing in the balance sheet. Now I want to make some more analysis with you. This time I'm ready with some more concrete rules coming for consolidation. Now let's go back. If you compare this balance sheet with the parent company, individual balance sheet of the parent and console, this is the new addition. The non-current assets increased by 200. The current assets increased by 100. The share capital, other equity is same. The NCI is being added and the current liabilities increased by 50. These are the additions compared to the balance sheet of the parent. Now let's see. If you see 200 plus 100 is 300, 300 minus 50, the net assets appearing in the balance sheet is 250. And we have also represented the goodwill as a separate line item, that is 100. And we have got an NCI on the liability side, that is 50. So if you compare the net figure, this is equal to 300. So let me now make another statement. Investment is replaced by 100% net assets minus NCI. I repeat. I'm saying investment is replaced by 100% net assets minus NCI. So you are consolidating 100% of the net assets, but you're representing an NCI as well. So indirectly, you are aggregating the share in the net assets plus goodwill. Investment is getting replaced by 100% net assets and NCI, which is indirectly share in the net assets plus goodwill. Agreed. Do you agree on this? That as far as the investment is concerned, it is getting replaced. Great. So we can say investment is being replaced. Investment is being replaced by. The investment is being replaced by 100% of the net assets minus the NCI and plus the goodwill. So investment is indirectly getting represented by share in the net assets and goodwill. So can we make a statement, investment is indirectly appearing in the console at the share in the net assets plus goodwill? If you have done Indus 12 and you would have done the concept of investments comparison, you would recall that this is the concept. That investment in the consolidated balance sheet appears at indirectly equal to the share in the net assets plus goodwill. Yes, it doesn't appear at a very apparent level, but it is indirectly inserted in the balance sheet. Because when you replace the investment by the net assets, goodwill, and NCI, investment in the console indirectly appears at the share in the net assets because you take full net assets and NCI and also the goodwill. Getting a little more complicated. I hope, friends, I am 100% clear on the case number 2 as well. Superb indeed. Now we are going to go to the case number 3. So I did case number 1 where it was no NCI but acquisition date consolidation. Case number 2, NCI and acquisition date consolidation. So what we're going to do next is, let's go next year. So we are going to go to the case number 3, consolidation year later with no NCI. Case number 4, consolidation year later with NCI. Trust me, there is no fifth case in the world. You can either get a consolidation on acquisition date with without NCI, case 1, 2. Consolidation later with without NCI, case 3 and 4. There is no fifth case in the world. These are only the 4 permutation combinations. But before we go to the case number 3, I just like to give you certain rules once again. I'm now going to give you 5 rules. Don't worry, we'll document them later, but just hear the 5 rules very carefully. Rule number 1, I'm not saying principle, I'm calling them rule number because my consolidation is creating certain rules. So I'll give you 5 rules for consolidations to begin with. Rule number 1. Investment in the subsidiary never ever appears in the console. Rule 1. Don't worry, we'll document later. Goodwill and NCI appears as a separate line item in the console. Equity share capital of the subsidiary never ever appears in the console. Next, the other equity of the subsidiary never ever appears in the console so far. I might change. So I'm saying investment in subsidiary does not appear in the console. Equity share capital of subsidiary never appears in the console. Other equity of the subsidiary never appears in the console so far. And goodwill NCI appears as a separate line item. And number 5, aggregate all the assets and liability irrespective of the percentage, whether it is 100 or it is below 100. Did you get my point? Right? Everybody is clear. Don't worry, we'll document these rules. We're developing the logic in terms of consolidation. We will document all the rules at a later stage. Super. Let's go to the third case now. I'm now going to take you to the case number 3. It's all mathematical things. Now we are looking at holding has got shares in the subsidiary 100%. And we are going to make a consolidated balance sheet later. Here I'm considering 1 year later. Extension of the case number 1. The case number 3 is an extension of the case 1. Case 1 was consolidation acquisition date. I want to do the consolidation year later. So this is extension of the case 1. It is the extension of the case number 1. But I need to give you the balance sheets, of course, the new balance sheet, because we need now the balance sheet of the companies 1 year later. So I need the new balance sheets. Let's make the balance sheet of the holding, and let's make the balance sheet of the subsidiary, and we are going to make a consolidated balance sheet as well. So this is the balance sheet 1 year later for the holding. This is the balance sheet of the subsidiary 1 year later. And this is the consolidated balance sheet. So I'm going to give you two separate balance sheets of the parent and subsidiary, which is 1 year later. And then we are going to make a consolidated balance sheet as well. Few things, of course, I'll not change. I'll keep them same. Let me just go back to the balance sheet and let's keep. Investments will remain the same. Equity share capital would remain the same. Rest, I'll just slightly change it arbitrarily. I'm just changing them arbitrarily. So let's keep the NCA at 600. Let's keep the non-current assets at 600. Must have been some purchase depreciations. Let's keep the investments same at 300. And let's keep the non-current assets at 250. So I've kept only the investment the same. Equity share capital, I'll keep it at 200. So equity share capital, will keep it at 200. And current liabilities, I'll keep it as 150. Let's see what is the other equity as a balancing figure. Just changing the figures arbitrarily. So this, I guess, works out at 800, I think. So earlier it was 700. So can you tell me what is this increase of 100 representing? If your other equity was 700 on the acquisition date and it is standing at 800, does this mean that this is the profits earned during the current year? Yes. This 100 is nothing, but it is the profits earned in the current year. Correct. Let's go further. So for the subsidiary also, I'm going to keep a slight change on the non-current assets. Let's make it 300. So non-current assets, let's make it 300. Current assets, let's make it 150. Current liabilities, let's make it 100. Just making some changes arbitrarily. Equity share capital continues to be 100. So let me consider what is the other equity as a balancing figure. So this is going to be 300 plus 150, and I guess this works out at 250 is the balance. And if you consider the other equity earlier, it was 150, so which means that this is 150 plus a profits earned during the year. So I just made some slight changes in the figures to get the results. Now friends, something important. Is the goodwill computed on acquisition date going to remain the same in case 3 or will it change? Think carefully and answer. Is the goodwill which you identified in case number 1, is that going to undergo a change or would remain the same? Think carefully and evaluate this. The goodwill which you computed in case 1 on acquisition date, is that going to remain the same 1 year later or is this going to undergo a change? Okay, I'm getting the answer that it'll undergo a change. Why should it change? Let me tell you one thing. Goodwill computed under Ind AS is not supposed to be amortized. And goodwill is only tested for impairment. The goodwill identified on acquisition date will never ever undergo a change unless there is any kind of impairments. It'll change as net assets got changed. No. How can you tell your stakeholders that the amount of premium which you paid on acquisition, how can that undergo a change? If you said you paid a X amount of premium on acquisition date, that premium paid cannot increase. Yes, it can go down if there has been impairment. So remember another important input. The goodwill which you identify as per Ind AS 103 on the acquisition date remains the same throughout unless there is any impairment. So let me put it out here. So I am considering the goodwill. What was my goodwill in case 1? I think it was 50. Let me put it point blank. It remains same. It remains same unless there is impairment. Unless there is impairment. So unless you've got some impairment as per IS 30, as per Ind AS 36. So unless there is going to be impairment under Ind AS 36, this goodwill will never ever undergo a change. That is the reason I'm showing you the case number 3 in the movement. Goodwill identified on acquisition date will never ever undergo a change unless there has been any impairment testing done under Ind AS 36. So I'm assuming there is no impairment. The goodwill is same. Now friends, I want you to have a look very carefully again on this. If you look at a comparison for the calculation of goodwill, you took this 300, yes. You took this 100, yes. You took this 150, yes. You took the impact of goodwill by comparing 300, 100 and 150. 100 which is earned in the post period, that is earned in the post acquisition period, is not taken in the goodwill calculation. I repeat, mathematics. 100 which is the post acquisition change. This is the profits earned after acquisition date. It is called a post acquisition profits. This 100 which is a post acquisition profits is not taken in goodwill. So if it is not taken in goodwill, will it appear in the consolidated balance sheet? Say yes or no. The amount of post-acquisition profits is not taken in the goodwill calculations. If it is not taken in the goodwill calculations, in this particular case, is this 100 going to appear in the consolidated balance sheet? Mathematically, yes. So what we're going to do in this particular case, when you consider the other equity that is supposed to be 800, the parent will say that whatever is earned in the post-acquisition period, it is my earnings. As a group, it is my share. So whatever the subsidiary company earned in the post-acquisition period, whatever the subsidiary company earned in the post-acquisition period, this is my stake. I've got 100% stake in this. A little early, but I want to make a statement. Can I say in the case number 4, where I will take a 20% NCI, I will consider 80% of this belongs to the parent and 20% of this belongs to the NCI. Makes sense? Right now, since the parent has got 100% stake, so entire 100% is added to the other equity of the parent. But if it was 80%, 80% goes in other equity and 20% should enter the NCI, because the share will be split between the parent and the NCI. Makes logical sense. I think I'm done with the balance sheet now. I have taken the net impact of these 3 figures, the post-acquisition inserted separately. Now you can just add 1 to 1. Just add 1 to 1. Let's add the non-current assets. 600 and 300 makes it 900. Investment is gone. Current assets, add the 2, that is 250 and 150 makes it 400. Add them. Share capital will be only for the parent company, that's 200. Other equity, we have added the post, and we consider the current liability 150 and 100, that makes it 250. Let's see if the consolidated balance sheet is agreed. Let's see if this is agreed. I think that comes to 1350, and I think this is also 1350. The consolidated balance sheet is done. I guess, friends, now I am in a position to make some very strong statements at this stage. Get ready to vouch me. I'll document all later. So before we go to the case number 4, I want to make some strong statements at this stage. Investment of holding in subsidiary never ever appears in the console. I'm now making strong statements. I'm saying investment in the subsidiary company never ever appears in the console. Number two, equity share capital of the subsidiary never ever appears in the console. Strong statement. Number three, other equity of the subsidiary split between pre and post. Mind the words. Other equity of the subsidiary split between pre and post. Pre never ever appears in the console. Post appears in the console. Split between the parent and the NCI. Now I rectified the statement. So statement number one, investment never appears in the console. Statement number two, equity share capital subsidiary never appears in the console. Number three, other equity subsidiaries split in pre and post. Pre never appears in the console. Post appears in the console. Share of the parent in other equity, share of the NCI in NCI. Wonderful. Next, number four, goodwill and NCI will appear as a separate line items in the console. And number five, you aggregate all the assets and liability one to one, irrespective of the percentage. 5 rules of consolidation, and when you put them together, consolidated balance sheet. Did you get the concept? And I think you can manage the case number 4, though I'll do that. But you need to keep these 5 golden rules into account for consolidation: that investment not to appear, equity share capital subsidiary not to appear, other equity split pre-post, goodwill NCI separate line item, and aggregate assets liability always full. Super. We will convert all this in a very chronological order of steps to handle any kind of question. Let's go to the case number 4 now. Let's go to the case number 4. So I am now on the case number 4, my last case to build my concept. This is a case where the holding is got in the subsidiary 80% stake, which means an NCI of 20%. Extension of the case number 2. Extension of the case number 2. And I am making the consolidated balance sheet later, which in this example is 1 year later. So I'll use the balance sheet of case 3. I'll use the balance sheet of case 3, though it's an extension of case 2. So this is an extension of the case number 2. It is an extension of the case number 2, though I'm going to use the balance sheet which I gave you in case 3 1 year later to make the console. I need your help now. So let me make my consolidated balance sheet. So let me make my consolidated balance sheet now at this stage. Is the goodwill identified in step 2 going to be the same in case 4, or will it change? You identified the goodwill on the acquisition date. Is that goodwill going to change or remain the same? I like it, because there is no impairment. So goodwill which is identified in the case number 2 remains the same. Same as case number 2. We are indirectly saying that there is no impairment. Otherwise, it would have undergone a change. And we've got an NCI. The NCI which was there on the acquisition date was 50. The NCI on the acquisition date was 50 in case number 2. Now what do you need to do? Can I say the post-acquisition earning is 100? Out of that 100, 80% to the parent, 20% to the NCI. So we're going to consider out of the post-acquisition share, 20% belongs to the NCI. That works out at 70. Can I copy rest of the figures from the case number 3? Can I simply copy the net non-current assets, current assets, the current liabilities from case number 3? Yes, you can. But except that the other equity, you need to be cautious. So let me just take the other equity. The other equity is now 800. The other equity of the parent company is 800. You cannot add 100. You need to take only 80%. So 80% belongs to the parent and 20% belongs to the NCI. Rest you can. So this comes to, I think, 880. Then you can simply take the non-current assets and the current assets. Take it from case 3. Aggregation is always full. 900 and 400. Share capital will be only for the parent company. That is 200. And you can add the current liabilities. That is 250. I guess this should tally the balance sheet as well. Let's see if the balance sheet is agreed. I guess that's 1400. And this is coming to 880 plus 270 plus 250. Yes, the balance sheet is tallied at 1400. Super. I guess, friends, I have done my best now, and I've created some golden rules of consolidations in life. I think I should pen down those golden rules at this stage, lest we forget, undoubtedly. So let's do one thing. Let's pen down the golden rules which we've created. So we have created 5 rules for preparing consolidated balance sheet. We've created 5 rules for making a consolidated balance sheet. We will also talk of a consolidated P&L separately. Right now, the focus is in terms of discussing the concept of consolidated balance sheet. We'll talk of the consolidated income statement separately. Focus right now is on the balance sheet. So we can say rule number 1, investment which the holding has in the subsidiary never appears in consolidated balance sheet. This is one golden rule which we need to keep in mind, that when you're looking at investment, holding is got in subsidiary never ever appears in the console. Number 2, equity share capital of the subsidiary company never appears in the consolidated balance sheet. Now you know the logic's very clear, because through the 4 cases I've already given you the logics as well. Next, the third one is, we can say other equity, OE, other equity of subsidiary is split between pre and post acquisition. It is split between pre-acquisition and it is split between post-acquisition. So basically, we'll learn the art of splitting the equity of the subsidiary between pre and post, and that is what we're going to call later analysis of other equity. So it's going to be split between pre and post equity. So pre-acquisition equity never appears in consolidated balance sheet. It never appears in consolidated balance sheet. And when it comes to the post-acquisition, in this case, in terms of post-acquisition, it is allocated to holding company and NCI. So we divided between the holding and the NCI. You know, holding goes to other equity, NCI goes to NCI. So whatever is the share of the holding company is added to other equity, and whatever belongs to the NCI is added to NCI. So when you make the consolidated balance sheet, the share of the NCI added to the NCI, the share of the parent is added to the other equity. Then we've got the rule number 4, and the rule number 4 is goodwill and NCI appears as a separate line item. Appears as a separate line item. It appears as a separate line item in consolidated balance sheet. So they are going to be represented as a separate line item in the consolidated balance sheet. And finally, we've got the rule number 5. You need to aggregate 100% assets and liabilities. You need to aggregate 100% assets and liabilities irrespective NCI is there or not. Irrespective NCI is there or not. So whether there is an NCI or there is no NCI, it does not make any differences to me. Right, friends, I think I've made my inputs at this stage. I hope you're all catched up with the concept. So far, so good. Correct? Are we absolutely clear with the fundas? Any questions come into your minds, please ask me at this stage, because we have created a base on the basis of which now we're going to create a building. Foundations done. Okay, so far so good on this. That's brilliant indeed. Now, before we go on to a little more detailing of steps, this is not my steps. I am also going to give you a 7-step model. Oh my God. So you gave us a 7-step model in terms of Ind AS 103. I'm going to give you a 7-step model in terms of Ind AS 110 consolidation as well. But before I give you the 7-step model, I think it is necessary to discuss a few adjustments with you as well. Because during this entire process of consolidation, you're going to see some kind of complicated adjustments as well. Or maybe we can discuss the adjustments a little later. Let's, I think, first lay down the 7 steps. Let's see how we are going to proceed with the question. Now, so far it's not been very technical, but I think as I'm going to give you the steps, till we see the practical applications of these questions, you might feel, this is, what is this? Don't get worried. Once we do the questions, we get clarity. So let me do one thing. Let me now, first of all, give you the 7-step model. The 7 steps model for consolidated balance sheet. I'm going to give you what is a 7-step model for making a consolidated balance sheet, which stems out of my 4 cases itself. All what I've taught you in the 4 cases, I'm going to now create 7 steps to crack any kind of question. My advice is that in the exam, please go with the step-by-step approach. You'll never ever go wrong. So what we're going to do, today, I'm going to give you this 7-step model, which is like a plain vanilla ice cream. Oh my God, Sunday morning, ice cream, vanilla. Later on in the coming week, what I'll do, I'll add some chocolate chips to it. I will give you some more inputs in terms of, the kind of complications which can arise in each step. Because we need to reach a stage where we want to do some complicated questions with you. So first, I'll give you today the plain vanilla steps, 7 steps. We'll revisit on these 7 steps and add some chocolate chips and chocolates to it later, once we are able to do some questions. So we'll revisit on these steps once again. So let's begin with the step number 1. I would say in terms of step number 1, you need to just identify 2 things. Just note them, that's it. So when you look at the question, the first thing you need to do is look at the date of acquisition and look at the percentage of holding. That's it. This cannot be a very technical exercise. It's going to be a very simple little exercise. Vanilla to mint choco. Yes. So the first step is going to be just identifying what is the date of acquisition and the percentage. That's it. Then I go to the step number 2. Now, friends, watch me. You've seen that there are a total of 4 cases. I'll block them in terms of 2 cases. Either you are required to make a consolidated balance sheet on acquisition date with or without NCI, or you're required to make a consolidated balance sheet which is later with or without NCI. So in step number 2, what you need to do, you need to identify the type of question. In step number 2, you need to identify the type of the question. And as I said, there will be 2 types of question. You need to see that do we need to make a consolidated balance sheet on date of acquisition, or do we need to make a consolidated balance sheet which is later? So just see that is the question based on category 1, balance sheet on acquisition date. NCI, no NCI, doesn't make a difference. So this is a case where there is NCI. NCI is there or not doesn't make a difference. Here also, whether NCI is there or not, that doesn't make a difference. Just categorize the questions into 2 categories. Is it on balance sheet date or is it late date? Now, let me ask you, in terms of the question where you are required to make a balance sheet on acquisition date, is the entire other equity pre? If you are required to make the consolidated balance sheet on the acquisition date itself, is the entire equity of subsidiary pre? Yes, there is no post. So in this case, analysis of other equity, not required. But in this case, analysis of other equity required. In this case, analysis of other equity is required, because in this case, entire profit is pre, but in this case, you need to split between what is pre and what is post. How do you do the analysis? We'll see later. So this becomes a step number 2A, and then we've got step number 2B. This is step number 2A, and we'll do step number 2B. So step number 2 will be in 2 steps. Step number 2A is doing the analysis. In the first category, no analysis. In the second category, analysis required. Now, for goodwill calculations, I need the list of net assets. For the goodwill calculations, I need the list of the net assets. Now, watch this carefully. Please see this carefully. If it is category number 1, question, how would you get the net assets? I will get the net assets by taking the assets minus liability. If it is going to be the category number 2, how will I take the net assets? I will take the sum total of the equity share capital plus the other equity, which is pre-acquisition, because I need the net assets on date of acquisition. Remember, I said there are 2 techniques of calculating net assets: assets minus liability, equity share capital plus other equity. So I'll use a different technique. In this case, I will take my net assets by the sum total of the share capital and other equity pre, which you're going to get from step number 2A. But in this case, I'll comfortably take assets minus liabilities. So can I take equity share capital plus other equity? Okay, but later you might decide differently. It's okay. So this is step number 2A and B. Then we come to the step number 3. Now, in terms of the step number 3, which you may not require in most of the cases, but I would advise, even if it is not required, get into the habit of step 3. And what is step 3? Organize the purchase consideration. If you notice that sometimes the investment in the balance sheet itself is the entire PC, but sometimes the investment may not be fully recorded. He may give you a question where the parent company's balance sheet does not incorporate all the considerations. So there might be some considerations which are not yet recorded in the books of the parent. So my advice is, please organize the purchase consideration. You need it for goodwill. And you know what? When you are organizing the purchase consideration, it should remind you the list of 7 issues which I gave you in Ind AS 103. When you're looking at the concept of this purchase consideration, your mind should get tuned to all the 7 issues which you did in Ind AS 103. So at this stage, you need to keep the 7 issues which we discussed in Ind AS 103, business combination standard, because all those issues, some of these issues can get inserted out here as well. So when you're calculating a purchase consideration, think of those 7 issues: DCE, CCE, CCS, TC, SBP, PHI, pre-existing relationship. That'll help you in step number 3. Then we come to the step number 4. In terms of step number 4, we'll organize the NCI. We'll organize the NCI. Now, when you're organizing the NCI, focus on the case 4 which we did. In terms of NCI, we will first consider NCI on date of acquisition. We will take the NCI at date of acquisition, which is in accordance with Ind AS 103 again. Either it is taken at a fair value or it is taken at PASNA. When you're considering the NCI on date of acquisition, we need to consider that. So why can't we do assets and liabilities in both cases? No worry, you'll get the answer, because we will be having fair value adjustments as well. Since we're getting fair value adjustments, it's going to be dangerous to consider assets minus liabilities in this case. I will be incorporating the fair value adjustments in the analysis of other equity itself. So because of those fair value adjustments, considering assets minus liability cannot be done. And there is another reason. Good, you asked me. Since you need the net assets on date of acquisition, mind it carefully. Since you need a net assets on date of acquisition, the examiner would be giving you the balance sheet of parent subsidiary, not on the date of acquisition, but on the balance sheet date. So let's say the acquisition was at the beginning of the year and he's asking you a consolidation year later. He'll give you the balance sheets about the company year later. How would you derive the net assets on acquisition date? Because the list of the net assets on acquisition date will not be available. So in this particular case, even if you want, you may not be able to organize the net assets as assets minus liability, because he may not give you the position of all the assets and liability on the acquisition dates at the fair value. So the best way to calculate would always be equity share capital plus pre-equity. Great. So coming back to the step number 4, you are going to consider the NCI on date of acquisition computed in accordance with Ind AS 103, NCI or PASNA. And to this we will add just what you did in case number 4. Can I say share in post-acquisition profits? Can you tell me in figures what was the share in post-acquisition profits in case 4? I guess the subsidiary earned the profits of 100, out of which 80% went to other equity, 20% was added to the NCI. So can I say this is the share in the post-acquisition profits which you will add, and then you will get your NCI on balance sheet date. Wonderful indeed. That's great. So this is step number 4. Now let's come to the step number 5. Now let's have a look in terms of step number 5. In terms of the step number 5, now what we need to do, we need to calculate the goodwill or the bargain purchase gain. In step number 5, you need to calculate a goodwill or bargain purchase gain. 100% same as Ind AS 103, no changes at all. But so what I'll do, I'll take this goodwill as per Ind AS 103 exactly. I'll take this based on Ind AS 103, and then we will reduce the impairment loss if any. We'll have to reduce the impairment loss if any, because if there is any impairment loss, you need to reduce the goodwill by the impairment, because what you calculated as goodwill on acquisition date might have undergone a change over the post-acquisition period because of impairment. So you will reduce the impairment of goodwill, if any, and then get the figure. That's how the goodwill will be done. Step number 5. So when you are doing every step, just focus on the concerned step itself. Don't think anything except the concerned step. Then comes the step number 6. Then comes the step number 6. And in step number 6, we will calculate, for the purposes of consolidated balance sheet, we will calculate what is the other equity. So we will calculate for the purposes of consolidated balance sheet, what is my other equity? If you remember case number 4, other equity is the holding company's own equity, and we add the share in the post acquisition of the subsidiary. We took that 800 plus 80% in this case. So we can say what we need to consider. We will consider holding company's own other equity. We will consider holding company's own other equity, and to this we will add the share in, post acquisition profits. We will add the share in post acquisition profits. And if you remember, we took that 80% of 100, 80 was added to the other equity. So this will give me the sum total of the consolidated balance sheet figure. Basically what we did in terms of the 4 cases, we're just organizing it in a very chronological order in terms of the 7 steps. Finally, we come to the step number 7. And in terms of step number 7, you are ready to make a consolidated balance sheet. And to make the consolidated balance sheet, I've already given you the 5 rules for making a consolidated balance sheet. So we will make the consolidated balance sheet and we will apply the 5 rules I gave you earlier. I'll apply the 5 rules which is written earlier. We've already given that 5 rules to you, that what are the 5 golden rules to be kept. Investment not to appear, equity share capital subsidy not to appear, other equity split, goodwill NCI separate line items, aggregate assets and liability full, irrespective of the percentage, those golden rules will be applied. Let me now consolidate the picture once again before we go to the larger question. So remember, when you are doing a consolidated balance sheet, how are you going to tune your mind in terms of a 7-step model? So you're going to tune your mind in terms of step number 1, which is not at all any challenge. In step number 1, you just need to read the question, get the acquisition date and percentage, as simple as that. Step number 2, organize in 2 sub-steps, 2A and B, for which you need to tune your mind that you need to first see the category of question. You need to see, is the balance sheet required on acquisition date or is the consolidation required later years? If it is required on the acquisition date, no analysis is required because the entire equity in the balance sheet is free. Then you just need to make a list of the net assets by taking the assets minus liability, which is given on the acquisition date itself. And when you are considering that it is a case where the consolidation is later, step number 2A and B will come into play. In terms of step number 2A, you need to consider the analysis of other equity. How do you do the analysis? We'll see. But you need to split the other equity of the subsidiary as pre and post. And then you will organize the net assets, but don't take assets minus liability, because I will not even know what is the assets and liability on the acquisition date. So I will take the equity share capital and add the pre-acquisition equity, which is as good as net assets on the acquisition date. In step 3, you need to organize the purchase consideration. Keep those 7 issues which you did in Ind AS 103. In step number 4, you need to take the NCI exactly as per Ind AS 103. But you need to add the post-acquisition share separately out here. Then you've got the step number 5, and in terms of step 5, goodwill is again based on Ind AS 103 minus the impairment if any. In step number 6, I'll try to organize what is the amount of other equity which will appear in the consolidated balance sheet, which is holding company's own profits and the share in the post-acquisition earnings. And then I'll make my consolidated balance sheet applying the 5 basic principles in this case. I hope, friends, the structure of the 7-step model is clear. As we do the questions, we'll get more clarities on thoughts. Great. Now let's do one thing. Before we go on to the consolidated balance sheet, a little comprehensive questions, I want to teach you at least two adjustments to begin with. Because as a part of the consolidation process, you will get some adjustments as well, and there can be typical kind of adjustments. One is called intercompany owings. One is called unrealized profit adjustments. One is called fair value adjustments. So let me not introduce all the adjustments to you at this stage, but there are three main adjustments which you will confront in most of the questions. So one of the adjustments will be intercompany eliminations between them. One is the unrealized profit eliminations, and one would be the case of fair value adjustments. These are three, I would say, most common kind of adjustments. So before we'll get on to the questions with you, let's understand at least two adjustments to begin with. So we'll start with the special adjustments. We'll start with the special adjustments for consolidated balance sheet. So we're going to look at what kind of adjustments can be given for a consolidated balance sheet. I'll start with the adjustment number one. And the adjustment number one is called elimination. It is called elimination of intercompany owings. It is called elimination of intercompany owings. Now, what is this elimination of intercompany owings? We'll see with an example. So this is elimination of intercompany owings. Let me also now tune your mind that when adjustments are going to be given in the question, you also need to map in your mind that do I consider this adjustment in which step? Mind it. You know, the best way of getting a grip on the consolidation process is to identify that if such an adjustment is given in the question, which step is going to undergo a change. So first, let's understand the adjustments. Then I will also tell you the crux that, this adjustment is going to impact which of my 7-step model. Let's consider the balance sheet of the holding and the balance sheet of the subsidiary. And let's consider the consolidated balance sheet as well. So this is the balance sheet of the holding subsidiary, and this is the consolidated balance sheet. Now let's assume the parent company made a credit sale to the subsidiary company, and therefore they've got a debtor-creditor relationship. So let's say, for example, the parent in its balance sheet is saying that there is a trade receivable recoverable from the subsidiary, let's say to the extent of 20 lakhs. And the subsidiary company also in its balance sheet says on the liability side that there is a trades payable which is 20 lakhs payable to the parent company. So they are basically entered into a transaction where they have got a debtor-creditor relationship. So he says, I need to recover money from you. He says, I need to pay you money. Now, what happens when you make a consolidated balance sheet? You add up the trade receivables of holding and subsidiary. When you take the trades payable, you add up the trades payable of holding and subsidiary. I think you'll easily vouch me. Is this including the 20 lakhs? And is this also including the 20 lakhs? Of course. When you aggregated the assets and liability, 20 lakhs is a part of the trade receivable and 20 lakhs is a part of the trades payable as well. So what is more logical? In this balance sheet, you are saying 20 lakhs is what I need to recover from my own group company. 20 lakhs is what I need to pay to my own group company. So logically, what I should do, I should eliminate this 20 lakhs out of the balance sheet from both the assets and liability. I guess makes logical sense. That's right. By the way, will it make a difference if the debtors was in the subsidiary and the creditors was in the parent company? Would that make any difference? If this was a case of a trades payable and this was a case of a trade receivable, would that make a difference? No. It doesn't make a difference that in whose balance sheet it is a debtor or a creditor, the accounting treatment remains the same. So would you like to guess that this will impact which step? What do you think this is going to impact which step number? Is it only going to impact my step number 7? Can I outrightly say that? Because if there is an intercompany owing, I guess this is going to be done only in the consolidated balance sheet. So if you see in the additional information anything like an intercompany elimination, it will impact step number 7 only. It'll impact the step number 7 only. Finally, you can do that in the consolidated balance sheet. I hope, friends, I am pretty much clear on the adjustment number 1. There is no complications on the adjustment number 1. Now we can go to the adjustment number 2. Wonderful. So let's talk in terms of the next adjustment with you. That is adjustment number 2. And this is called elimination. This is called elimination of unrealized profits. This is called elimination of unrealized profits. So let's see what is this elimination of unrealized profits going to look like. It is quite possible that the parent made a sale to the subsidiary or the subsidiary made a sale to the parent. Now watch this. In case of elimination of unrealized profits, you need to be careful who made a sale. Unlike intercompany elimination, it did not make any difference whether it's a debtor or creditor in whose balance sheet. But when it comes to elimination of unrealized profit, you need to focus very carefully that you need to see that is the sale made by the parent company, and that is called downstream. Or if the sale is made by the subsidiary to the parent company, and that is called upstream. So when you look at the elimination of unrealized profits, you need to watch out that it makes a difference who made a sale. Is it by parent to subsidiary? Downstream. If it is subsidiary to holding, upstream. So what are you going to do in this particular case? You will first watch out. You will first watch out that is it supposed to be a downstream transaction? We'll have to first of all identify the kind of the transaction, that is it downstream or is it supposed to be called upstream in nature? And I think the nomenclature itself is logical. When you say the sale is made by the holding to subsidiary, it flows down. But if the sale is made by the subsidiary to holding, it is supposed to be upstream in nature. Now, let's first understand the basic concept. Then we'll look at the steps it will impact. Let's see, first of all, the downstream. Let's say this is the balance sheet of the holding, and this is the balance sheet of the subsidiary, and this is the consolidated balance sheet. So let's say this is the balance sheet of the holding subsidiary, and this is the consolidated balance sheet. Let's assume some figures to understand the downstream transaction. Let's say the parent company made a sale, a credit sale to the subsidiary. And the sale is made for goods which are costing, let's say, 20 lakhs. And it is sold, let's say, at 25 lakhs. So the parent company made a credit sale of goods which is costing 20 lakhs at a selling price of 25 lakhs to the subsidiary. Now, what did the parent company do? When he made a sale, can I say he would have recorded this profit as a part of the other equity in the balance sheet? Because when he made a sale, he would have recorded that sale as a part of his income statement, and it would get accumulated in the other equity in the balance sheet. The subsidiary would be reflecting this goods purchased as a stock in the balance sheet at 25 lakhs. Now the question rises, when you are going to make a consolidated balance sheet, you will consider the stock of both the holding and the subsidiary put together. So can I say it makes sense that I should reduce this profit element from the stock itself? Because at the end of the day, the cost of the stock to the group as a whole is 20. The cost to the parent company was 20. He sold the goods to the subsidiary, and if it is still unsold, this profit is unrealized from the point of view of the group. Because the parent company in its standalone statement said, I got a profit. It's fine. But from the group point of view, the profit is still unrealized in nature. So we will eliminate that 5 lakhs out of the stock. And similarly, from the other equity also, we'll eliminate that 5 lakhs as well. Did you get my point? That I will eliminate the unrealized earnings from the stock and also eliminate the unrealized earnings from the other equity or the balance sheet as well. But remember, this elimination will be done only when the goods are unsold. If the parent made a sale to the subsidiary and he further made a third party sale, this elimination will not be done. So in this particular case, we can say this elimination will be done. So we will do this elimination only to the extent goods are unsold. Only to the extent the goods are unsold. So we will do the elimination only to the extent the goods are unsold. So let's assume that out of this, let's say 50% goods have been sold further to a third party. Do we eliminate 5 lakhs or do we eliminate 2.5? What do you say? If there is a third party sale which is made, do we eliminate the entire amount? That's right, only 2.5 lakh. So my elimination will be done only to the extent of unsold goods. And if everything is sold to a third party, then no elimination is required to be done. Great. Let's now see the other way around. Now let's see the same transaction if it is done by the subsidiary to the holding. Let's see what is the status in the balance sheet of the subsidiary and of the parent. This is holding, this is subsidiary, and this is consolidated balance sheet. Now hear this carefully. Let's see the movements if it is upstream in nature. Let's consider the same figures. Goods which are costing 20 is sold at 25 lakhs, but it is upstream in nature. So what happens? The subsidiary company would have recorded the profit of 5 lakhs as a part of his own other equity. So he would have recorded a profit of 5 lakhs in his other equity, and the parent would have recorded the stock at a cost price which is 25 lakhs to him. The sale by the subsidiary becomes a cost to the parent company, so he would have recorded the stock at 25 lakhs. Now, when you consider the consolidated balance sheet, you take the stock holding plus subsidiary. Now, I think this definitely makes sense that this stock should be eliminated by the unrealized profit. So we will reduce this 5 lakhs out here. Makes sense. Now we need to be a little careful on this. This 5 lakhs equity, correct? This 5 lakhs is a profits which will be split between the parent and the NCI. Because you will take this profit of 5 lakhs and say that 80% belongs to the parent and 20% belongs to the NCI. So can I say out of this you can say 80% enters the other equity and 20% enters the NCI. Am I making sense? Am I making sense, friends? That out of this other equity, 80% would go to the parent company, if there is 80%, and 20% will go to the NCI. So this 5 lakhs got split between the parent and the NCI. So you will eliminate the holding company's share from the other equity and you will eliminate the NCI share from the NCI. Makes sense? But the problem is that this can unnecessarily complicate the situation. So let's make your life simple now. I know this is complicated. Now let's make life a little simpler. So in terms of the downstream transaction, you could eliminate the profits from the balance sheet, stock, and other equity. But in terms of the upstream transaction, you eliminate the profits from the stock, but the profits from the liability side is split between the holding and NCI. So let's do one thing. Instead of doing this treatment, you eliminate this unrealized profits from the step number 2A when you do the analysis of equity. Please hear this carefully. Instead of doing this complication in terms of the balance sheet, you eliminate this unrealized profits in terms of step number 2A. In step number 2A, when you do the analysis, eliminate the profits. Automatically, the parent share will get adjusted. Automatically the NCI share will get adjusted, because when you eliminate this profits from the analysis of equity, automatically the profits will get eliminated, the parent share will get adjusted, the NCI share will get adjusted. But you still need to adjust the stock. And here again, this elimination is again to the extent of the unsold goods, if any. So let's now do one thing. We can just make a little consolidations at this stage. I just want to make a small little mapping in terms of the two adjustments what we have done. So I want to understand that out of these adjustments, which step is going to take a hit in terms of these calculations. So let's make a quick mind map on this particular stage. I am looking at the adjustment and I'm looking at the accounting treatment. Which steps are we going to consider the accounting treatment? That's what I want to look at. So I'm now going to give you 4 adjustments and you need to carefully decide the step number where the adjustments will be done. I am looking at intercompany. I'm looking at intercompany elimination. I'm looking at intercompany elimination where I'm looking at it is, let's say, a situation like this: a trade receivables in his balance sheet, a trades payable in his balance sheet, or it's a trades payable in this balance sheet and a trade receivable in this balance sheet. Can I directly make the adjustments in step number 7 in both cases? What do you say? Can I make the adjustments in step number 7 in both the cases? Don't touch any of the steps. When you make the consolidated balance sheet, eliminate from trade receivable, eliminate from trade payable. So in both cases, we can say you can take the impact in step number 7 itself. Absolutely correct. Let's now consider that there is an elimination. There is an elimination of unrealized profits. There is an elimination of the unrealized profits in this particular case. If there is an elimination of the unrealized profits, we're again considering that if it is supposed to be downstream. If it is supposed to be downstream, then what is to be done? And if it is supposed to be upstream, then what is to be done? So let me now make a statement again in terms of downstream as well as in terms of upstream. Can I say if it is supposed to be downstream in nature, I can take the impact in the step number 7. Reduce the stock, reduce the other equity. Rather, I'm now making some refinements. Take the impact of this element in step number 7 and take the impact of this element in step number 6. Mind you, I'm saying what you need to do, you can take the impact of this in step number 6 itself. And you can take the impact of this in terms of step number 7. Am I making sense? Because when you're going to make the consolidated balance sheet, other equity, step number 6, you can take care of the stock reserve, which is downstream in nature. So you can take care of this in step number 6, and this can be taken care in step number 7. So you can take care of this in terms of step number 6, and you can take care of this in step number 7. In terms of step number 7, you will basically reduce this stock. You will basically reduce the stock. And in terms of the step number 6, what you'll do, you'll reduce the stock reserve from the other equity. Now let's consider the impact of the upstream as well. Can I say, as I said, in terms of upstream, you will eliminate this from step number 2. When you would consider the analysis, when you would consider the analysis of equity itself, from the analysis of equity, you can reduce the post-acquisition profits. The subsidiary made this profit of 5 lakh rupees. So from the analysis, you eliminate that 5 lakh rupees itself. And then automatically the profits will get reduced. The parent gets a lesser share, the NCI gets a lesser share, but this is to be taken in step 7. So what we can do in this particular case, we can take care of this in step number 2A. We'll take care of this in step number 2A and in terms of step number 7. So what we'll do in terms of the step number 7 is the same thing. We will reduce the stock. We will reduce the stock in this particular case. And in terms of the step number 2A, what we can do, we can reduce the post-acquisition profits. We can reduce the post-acquisition profits and automatically everything will be taken care. So moral of the story, when you're going to make a consolidated balance sheet, apart from the 5 steps, you also need to consider these adjustments as well. Though I would say these adjustments are automatically going to enter my inputs in terms of various steps. So intercompany elimination, step 7, up or down. Stock reserve will be depending upon up and down. If it is down, step number 6 and 7. And if it is up, then it is step number 2A and step number 7. You know what? As we're going to go to more adjustments, and as I said, I'm going to convert these 7 steps into, choco kind of things. You need to be very clear on adjustments list. You should be clear if this is the adjustment, which step. If this is the adjustment, which step. Every adjustment, your mind should be tuned that the impact is to be taken under which step. Now, these are the 2 basic adjustments which I've given you so far. There is another adjustment as well, which is called a fair value adjustments. Now, I think what is that fair value adjustments, where it is taken, I think it's too early to give you that part. I think it's time, maybe we can give you a break at this stage. Otherwise, the mind will become too heavy with the fair value adjustments. So what I'll do, I will give you an exposure of a third adjustments, which is a fair value adjustments after the break. And then we will do a full-fledged question. But we'll do questions in stages. I'll first do a question on consolidation, where it is consolidation acquisition date, with or without NCI. Then we'll move on to the next area, that is we'll see the consolidation later with without NCI. And then what we'll do, we'll add on some more masalas. Not everything is going to be done today, of course. So we'll start off our journey with case number 1 and 2. We'll move on to case number 3 and 4. Then we'll add up some more complications in terms of adjustments, slowly and steadily, step by step. So I think let's take a break, friends. At this stage, we'll give you a 10-12 minutes break, and then I join you back and start the journey. Enjoy your break. Thank you. So I hope you had a relaxation of mind. So now before we do a comprehensive question with you, one more adjustment which I think we need to discuss, and that is called the fair value adjustment. Though we are already aware of this adjustment, because when we did Ind AS 103, we know that when you calculate a goodwill, you consider the net assets on acquisition date at a fair value. So accordingly, that is called a fair value adjustments. But we just need to see that, where are we going to take the impact of this fair value adjustments in terms of a 7 steps. So I think let's take you to the next area of adjustment. And let's talk of the adjustment number 3. And this is what we call the fair value adjustment. So this is the fair value adjustment. Now, let's visualize first of all, where would the impact fallen if there is a fair value adjustment? So first, as we said, that when you calculate a goodwill, you compare the sum total of the PC and the NCI, and it is compared with the net assets at a fair value on the date of acquisition, and that's how you get a goodwill or a capital reserve. Now, we need to appreciate that our analysis is based on the other equity. So if you just visualize the balance sheet of the company, so if you look at the balance sheet of the company, that is the balance sheet of the subsidiary. So you've taken the assets here and you've taken the liabilities here, and this is the equity share capital and this is the other equity. Now, once you consider the net assets as the sum total of this, because you can take assets minus liability, but we prefer the other approach, that is considering the sum total of the equity share capital plus other equity. In the financial statements of the subsidiary, these assets and liabilities are all appearing at a book value. Because when you're looking at a fair value adjustments, the fair value adjustments are for the consolidation perspective. But if you look at the financial statements of the subsidiary, the financial statements of the subsidiary contains all the assets and liabilities at a book value. So indirectly, when you consider the sum total of this is going to give you the net assets at a book value. This is going to give you the net assets at a book value. So which means that when you do the analysis of other equity, you are basically considering the net assets at a book value. Now, if let's say, for example, the PPE is taken at a fair value, the corresponding impact will also fall on the other equity. If you take the PPE or any other asset at a fair value, the corresponding impact will be that there will be a change in terms of other equity, which makes sense that we should incorporate this fair value adjustments as a part of the analysis of equity. And since this fair value adjustment is done on the date of acquisition, this will become a part of the pre-acquisition equity in step number 2A. That is 1. Which means I would take care of this impact number 1 in terms of step number 2A. So when you consider the step number 2A, any fair value adjustments, whether it's an increase or it's a decrease, this fair value adjustments will be considered as a part of pre-acquisition profits. So when we're going to split the profits between pre and post acquisition, this should be a part of the pre-acquisition profits. Reason, because you are taking the net assets on the date of acquisition, so we need to change the equity on the date of acquisition. So any fair value gain or loss will be a part of the pre-acquisition things. That's 1. Second, at the end of it, when you are going to make a consolidated balance sheet, the assets and liability also need to be carried at a fair value for the consolidated balance sheet as well. So what you can do, the next impact can be taken in terms of the step number 7. And in terms of step number 7, you can change the value of the asset or the liability, whatever the case might be, in the balance sheet as well. Now, there is something more which is also coming to my mind at this stage. When you are going to consider the fair value adjustments, one thing is true that you're going to take the impact in step number 2A, and you're also going to take the impact in terms of step number 7. But the moment you consider, let's say, for example, a PPE at a fair value, you need to go in for a change in the depreciation also on a prospective manner. So when you're going to consider this fair value adjustments, you should also be careful that as a part of this adjustments, there will be a need to consider the additional depreciation impact as well. There will be a need to consider additional depreciation as well. Because if the asset is increased in value, then the depreciation should change on a prospective level. So in this particular case, we'll take care of the additional depreciation, but this depreciation being taken prospectively will impact the post-acquisition profits. So this is what we need to consider, that this kind of a fair value adjustments will impact my step number 2A, and it'll impact my step number 7. When I take the asset or liability, I will incorporate the fair value gain or loss and also the additional depreciations and get the net value of the assets liability at that stage. I hope, friends, I made sense. So now my mind is tuned that I have covered 3 basic adjustments. You need to be very clear that which adjustments are going to be tackled in which area. The moment I say intercompany elimination, step 7. The moment I say it is unrealized profits, depends upstream or downstream in nature. If it is downstream in nature, step 6 and 7. If it is upstream in nature, then it is step number 2A and 7. And if it is a fair value adjustments, then it is step number 2A and step number 7. So when you're doing a question and you're concentrating on a given step, you need to be very tuned that these particular adjustments will impact this step. So I think I've already made some gateway where I am already looking at the refreshment of my 7-step model. Because I've already introduced some adjustments, we'll introduce some more adjustments and see under each step what further complications can arise. Because if you want to do a larger, bigger question, you need to be very clear that under each step, what complications can arise. If I am able to zero down a mind map, which will tell me that under each step, what kind of possible adjustments can come, life is going to be jingalala. I hope, friends, you got the position conceptually so far clear. Okay, I'm getting a question. So when we are making a consolidated balance sheet, we carry a subsidiaries balances at fair value. Yes. Technically, if you remember the concept of Ind AS 103, your acquisition entry incorporates everything at a fair value. So which means the subsidiaries standalone financials will be at a book value. But when I am going to make a consolidated balance sheet, I need to incorporate the fair values as per the instructions in the question. And every time the question will definitely give you some fair value adjustments for sure. As I said, 3 basic adjustments you're going to see in every question. You're going to see unrealized profits more or less every question, fair value adjustments more or less every question, and intercompany eliminations. More to go later. So far, so good. Now I think we are ready to go to a question with you. So I have taken a question from the study material itself, but I've just organized this question on a separate sheet. But this is a question which is there in the study material. So let's have a look at the question number 1 and the question number 2 combo offer indeed. So this is a question which is there in the study material itself, but I've just taken it on a separate page, but this is a study material question. So as you read, we'll first identify the category of the question. We'll go on a 7-step model in this case. So let's, I think, first read. It says on 31st March X2, Blue Heavens acquired 100% ordinary shares, which is carrying voting rights of Orange. If it is 100% shares, there is no NCI. Then he says it is acquired for 6,000 lakhs in cash and it is controlled Orange County from that date. The acquisition date, it says the acquisition date, statement of financial position of Blue Heavens and Orange County, and the fair values of the assets and liabilities recognized in Orange County statement of financial position is given. So you can clearly see that we are given the book value of the subsidiary and we're also given the fair values of assets and liabilities of the subsidiary as well. Now, in this particular case, we need to first of all see the category of question, either we are doing analysis of equity or not. This is the balance sheet on acquisition date, and we are required to make the consolidated balance sheet on 31st March, which is on the acquisition date itself. So that means it is a category 1 question where you are required to make a consolidated balance sheet on acquisition date itself with no NCI. I'm not going to look at case 1, 2, 3, 4. I'm going to broadly look at two cases that, one case is that there is supposed to be consolidation acquisition date because that does not need any analysis. But one is a consolidation later which needs analysis. Whether there is NCI or not, that doesn't make a difference to me. So this is a case where we are doing a consolidated balance sheet on the date of acquisition itself, which means no analysis required. Okay, then there is a question number 2, which is an extended version of this question. We'll come to that later. Let's, I think, start solving the question. So I am looking at, first of all, my step number 1. We're going to go religiously in terms of the 7 steps, no compromise, step by step. So in step number 1, we need to identify the 2 things. We need to get what is the date of acquisition, and we need to get what is the percentage of holding. So the percentage of holding is very clearly given. It is 100%. There is no NCI, and the date of acquisition is very clearly given. That is 31st March X2. As simple as that. You can never ever face any challenge in terms of step number 1. Then we go to step number 2. The moment you go to step number 2, you need to focus on the category of the question. This is a question where we are making a consolidation on the acquisition date. So step number 2A is not required. We can directly prepare a list of net assets. By the way, is this list of net assets same what you did in terms of Index 103? Yes. Did you get my point? When you're making this list of net assets in step number 2B, this list of net assets will also consider the impacts what we discussed in the step of Index 103. So you mean to say all those recognition, measurement, and recognition measurement exceptions? You got me correct. In a very comprehensive questions, you could see the examiner also giving you information as regards to the fact that there could be certain intangible assets which are not in the balance sheet of the subsidiary. There could be contingent liability adjustments. So whatever inputs you studied in Index 103 on the net assets, get track here as well. So we are looking at the step number 2B. So let me just make a quick mention as a note that you need to consider the same inputs of Ind AS 103. When you made a list of net assets under step number, I think it was step number 3 out there. So you need to do the same things out here. That was step number 3B, if I remember, because step number 3A was on deferred tax implication. Sir, you mean to say that there could be some deferred tax implications also coming in terms of consolidation? Why not? Let's not talk too much at this stage. Let's do the question simple now. So we're going to make a list of the net assets at this stage. So let's create a list of net assets. And this is the list of net assets at date of acquisition, and this is going to be taken at a fair value. So let's get back and see what are the net assets in this case. So we've got a building and PPE, that's 3,300. So we've got a building and a PPE, that's 3,300. So we are considering all the fair values. Next, I am given inventories is 600 and trade receivables is 250. So inventories and trade receivables. So we're going to consider all the fair values. So I'll take the fair values, that is 600 as well as 250. Let's go back to the balance sheet. So let's see, we're not missing out any items out here, and the cash, of course, is 700. So the cash is supposed to be 700. And then we come to the liabilities as well. In terms of liability, we're just given trades payable, that is 150. So minus the trades payable, that is 150. So this will give us the net assets on acquisition date. As simple as that. So that's going to be 3,300 plus 600 plus 250 plus 700. And I think it's coming to 4,700 if I am correct, right?
Yes, sir.
Wonderful indeed. So this is my step number 2B. 2A was not required for the reasons already stated. Then we go to the step number 3. And in terms of step 3, we need the purchase consideration. I don't see that there is any kind of omissions in terms of the purchase consideration. It is very clearly stated in the balance sheet of the parent that the investment is supposed to be 6,000. And he's very clearly said at the beginning as well that he acquired the shares at a cost of 6,000 by making a payment in cash. So my purchase consideration is supposed to be 6,000, very clearly stated in the question. Then we go to the step number 4, where we're going to calculate the NCI, and there is no NCI because 100% stake belongs to the parent company, so no NCI is given. Then we go to the step number 5, and in terms of step 5, we need a goodwill or a bargain purchase gain. Absolutely in lines with Indus 103, so we compare the purchase consideration 6,000, and to this we add the NCI, that is nil, so that works out at 6,000, and we compare this with the net assets that's already computed in step number 2B, that is 4,700, and this will give us the amount of goodwill, that is 1,300. I don't see that there is any impairment of goodwill given. Otherwise, we would have taken the impact of goodwill impairment as well, but we're not given any status on goodwill. Okay, that was step number 5. Let's see the step number 6. So in terms of the step number 6, we need to organize the consolidated balance sheet. What is the other equity? And we know now 2 things. When you're calculating the other equity in the balance sheet, you've got 2 things. One is you need to consider the post-acquisition share in profits. And the other is you need to consider the unrealized profit, which is downstream in nature. So when you're looking at the step number 6 as of now, you've got things in mind that there is post-acquisition earnings. In this case, it is not there. And there is unrealized profits elimination downstream, which is not there in this case. But I think still let's make mention on the format. So we've got holding companies own other equity. Let's consider holding companies own other equity. So we look at the retained earnings appearing in the balance sheet. It is appearing to the extent of 10,200. That is the retained earnings of the parent. So own retained earnings, that is 10,200, and to this we add share in post-acquisition profits. We consider the share in the post-acquisition profits. There is no post-acquisition period, so nothing is to be added. We also need to consider any unrealized profits. We also need to consider any unrealized profits, which is on downstream transaction, which of course is also not given. So this continues to be at 10,200 itself. Absolutely simple, absolutely straight indeed. Now we need to make the consolidated balance sheet, keeping the 5 principles which we decided. So let's go to the step number 7. And we are making a consolidated balance sheet in this case. So I guess let's start with the asset side of the balance sheet. So on the asset side, let's get back on the balance sheet. So we've got a building that would appear, of course, at fair valuation will be added, investments will disappear. So we take a building and PPE, 7,000 and 3,300. So we've got a PPE, the parent is 7,000, and we incorporate the fair value adjustments out here. There was no additional depreciation because there was no post-acquisition period in this case. So that works out at 10,300. Least we forget, let's consider the goodwill as well. And the goodwill is appearing at 1,300. So let's get back to the balance sheet. Building is done, investments will not appear, the NC is done. Then inventory, 700 plus 600. Inventory, that is current assets. So we take care of the inventories. This was non-current assets. That was 700 and a fair value that is 600 works out at 1,300. Next, we are given the trade receivables 300 plus 250. 300 plus 250 is the trade receivable. That is 550. That works out at trade receivable. We're just aggregating the fair values into account. Next, we are given the cash and cash equivalents. And the cash and the cash equivalents is 1,500 plus another 700. So 1,500 plus 700. So I think that's it on the asset side of the balance sheet. Goodwill has already been shown as a separate line item in the balance sheet.
15,650.
Wonderful. 15,650 is the total of the balance sheet. Okay, great. Now let's go to the equity and the liability side as well. So we consider equity and liabilities. First, I think we'll consider equity, in which we've got equity share capital and other equity. So as far as equity share capital is concerned, only for the
5,000.
parent, that's right, 5,000. And RE, that is other equity, you can pick from step number 6. That's right, 10,200 from the step number 6. Of course, in this question, there is no NCI, but you need to remember that as far as the NCI is concerned, it is going to be presented as a last item in the equity section. So when you present the equity section after the share capital and other equity, NCI would be a part of the equity section itself. Though in this case, of course, there is no NCI, but just to make a mention. Then I guess there is no non-current liabilities, just current liability, 300 plus 150. So we've got current liabilities, that is trade payable, 300 plus 150, that makes it 450. C is the balance sheet talent.
Tally, sir.
Wonderful. So 15,650 is the total of the balance sheet. Okay, this question is fairly done. I don't want to break your heart, but do you think this kind of a question can ever come in the exams? The answer is a big no. This is too simple to come, baby stuff. This was, I think, just a little application in terms of how the 7-step model is being applied. There was no unrealized profit adjustments. There was no intercompany eliminations. Fair value adjustments barely had an impact because you're doing a consolidation on acquisition date. So there's no impact except that when you take the balance sheet, you're adding up the fair value adjustments. That's it. Okay, that's wonderful indeed. Now, let's go back on the second part of the question. Now, there is a second question which is an extended version of the same question itself. So let's have a look at the next question number 2 in this case. But do please, friends, try these questions by hand. Whatever 4 cases I did, once you're going to go through them by your own hands, you'll get more and more expertise on the issue. By the way, what do you say? Is it different from your technique, what you did at the intermediate level? I'm just a little more keen to know that. No?
No, sir.
Then it's fine. Okay. But I think you might not have done these step-by-step inputs in terms of things. But in any case, if your mind is telling you to reconcile what you did in the inter and in this case, please don't do any reconciliations. Okay, let's go to the question number 2. It says, the facts are the same as in the above question. However, Blue Heaven acquires only 75% of the ordinary share to which voting rights are attached, and it paid 4,500 lakhs for the share. Which means now this investment for the next question comes to 4,500 as per the instructions given. So I need to redo this entire question considering 4,500. But if I consider 4,500, let me tell you one thing, my balance sheet is out. So what I'll do in this particular case, I'll change the cash to 3,000. If you're going to reduce the investments by 1,500 to match the balance sheet, I'm increasing the cash by 1,500. So I think I'm not interested in doing the question all over again. What I'll do, I've already done the question with you. On the side, I'll keep giving you what are the changes. I hope that works, right? Instead of doing all the 7 steps all over again, we can just do the changes, correct? I think that should be comfortable, I guess, correct. So let me just change the color and we can just have a look at the inputs coming in. So let me just change the color. I guess now in the next question, this has become 75%. I think this may not be much visible. Let me change the color. Let's keep it pink. So this is 75%. And any changes in the step number 2B? Would there be any changes in the step number 2B in this case? I don't think so. And the purchase consideration, of course, we have made changes. That is appearing at 4,500. Let me just also pinpoint this as well. This has become 75%. So no changes in step 2B, and NCI instead of 0 is now going to be computed. Since there is a 25% NCI and I'm not given the fair value status, we're going to take it at PASNA. So can we say the net assets is 4,700? So we take 25% of this. That is the NCI at PASNA. So 25% would mean 1,175. And of course, the goodwill will undergo a change as well. The figures have undergone a complete change. The PC is become 4,500. The NCI is 1,175. And this would mean 5,675. And the net assets remains at 4,700. So goodwill comes to 975. Right, I guess my journey on step number 5 is done. Let's go to the step number 6. Will there be any changes in terms of the step number 6 in this case? No, because there is no post-acquisition share. So otherwise, it would have impacted that you take 75%. So this remains the same. And the other is the NCI, which has been added at 1,175. So let's see if the balance sheet is agreed on this. 16,825.
Yes, sir.
Is it valid? What was the total, beta? 16,825, right?
Yes, sir. 16,825.
Perfect. So that is the balance sheet total. So it takes care of the second case as well. Well, if you would notice, I have done two questions with you. I've done the case 1 and case 2. We did a consolidation on acquisition date without NCI. We did a consolidation on acquisition date with NCI. So these two questions have taken care of case 1 and case 2. Now let's go to the next case with you. So now let's add on interesting question. Wow. This is going to be something beautiful to watch at, because you're going to see some dividends as well. This is question number 3, again picked up from the study material. It's very much there in the study material, but I've taken it on a separate sheet of paper just for explanation purposes. So let's read and identify the category of the questions as well. Now, in this particular case, friends, get ready for some technicality, because in this case, you're going to see something which is dividend, and there is going to be slightly little technical inputs. Hear me carefully. It says DEF acquired 100% shares on 1st October X1, and the balance sheet is given on 31st March X2. Which case is this, by the way? Of course, the category of question is balance sheet later. But otherwise, case 3 or case 4, which case is this? 100% no NCI, balance sheet at a later date. But I would put the category that this is a consolidated balance sheet at a later date. Are you going to consider the analysis of other equity? What do you say? Are you going to consider the analysis of other equity? This is a question which is a balance sheet at a later date.
Yes, sir.
Yes, of course. So we are given the summarized balance sheets of the two company, and then it says the retained earnings shows a credit balance of 3 lakh on 1st April X1, out of which a dividend of 10% is paid on 1st November. The parent company credited the dividend received to the retained earnings account. The fair value of the plant on 1st October is given, and the depreciation rates is also given 10%. The following are the increases on comparison of the fair value as per Ind AS with the books value on 1st October. So these are already the increases given to me in terms of trades payable, land building, and inventory. Now, whether these changes will be incorporated in the consolidated balance sheet or not depends upon the nature of the asset as well. For example, if you look at a trades payable, this was a change in the fair value. But if this amount is still pending, then I will incorporate the increase in the balance sheet. If the inventory is still unsold on the balance sheet date, I will incorporate that in the balance sheet. If the land and building is still unsold, I'll incorporate that in the balance sheet. But if these items have somewhere been sold, then in this particular case, I cannot incorporate the fair value adjustments in the balance sheet as well. I hope you got my point. Because when you're going to incorporate these fair value changes as a part of the step number 2A, you'll also have to consider them as a part of the balance sheet movement, but these fair value adjustments in step number 7 will be considered only if the inventory is still unsold, only if the trades payable is still pending to be settled. It says in the note, it may be assumed that inventory is still unsold on the balance sheet date and the trade payable is also not yet settled. Land and building, of course, is not going to be settled. Also assume that other reserves on March X2 are the same as on 1st April X1. No changes in the other reserve at the beginning and the year end, and we are required to make a consolidated balance sheet on March X2. Let's, I think, friends, begin the journey. I'm now going to make my 7-step models once again. Let's go step by step. So let's see. So I'm going to first begin with my step number 1. Step number 1 is simply getting the acquisition dates and the percentage. So let's see what is the date of acquisition and what is the percentage of holding. So I guess as far as the percentage of holding is concerned, it is 100 and the date of acquisition is 1st October X1. Correct. So there is no NCI in this particular case. Step 1 is pretty easy. Getting the date and the percentage is not a big issue. And now we go to the step number 2A. Now this is the crucial step. Now please hear this carefully because I need to spend a good time discussing the step number 2A with you. Rather, let me do one thing. Let me just organize my step number 2A out here on the right hand side. I'll organize my step number 2A on the right hand side. I need the analysis of other equity. I need the analysis of the other equity. Here I'll organize my step 2B. Now, when you do the analysis of other equity, you need to make a certain formatting. Take a column for particulars and take a column for pre and post. So when you do the analysis, take a column for particulars and take a column in terms of pre as well as post acquisition. I would advise when you do the analysis, define what is pre and define what is post in terms of dates. So we can say the pre-acquisition is something which is pre-acquisition date, 1st October X1. And post is anything from 1st October X1 till the balance sheet date, which is March X2. My balance sheet is on March X2. So it will be a good idea to define that what is a pre-acquisition, pre-1st October, and what is post from the acquisition date till the balance sheet date. Now, let's get the focus very clear. I may not be able to complete this question. I'm not even interested in completing the question at this stage. My main focus is to give you the analysis today, a little deeper inputs in this case. Now, when you do the analysis, my advice is your analysis is going to be built in 3 parts. Please hear me very carefully. I'm now looking at a question with a larger picture. So when you're going to do the analysis of equity, you're going to divide your analysis in 3 parts in every question. Now, what are the 3 parts in this particular case? My advice is that when you're looking at the part number 1, your part number 1 is going to focus in terms of the balance sheet of subsidiary company. I will focus on the balance sheet of the subsidiary company, that what is the other equity in the balance sheet of the subsidiary, split it between pre and post. That's going to be your focus number 1. You're going to focus on the other equity of the subsidiary. Your second focus point would be that you need to look at the fair value adjustments which are given in the additional information. Because even these fair value adjustments are to be incorporated as a part of pre. I'm just trying to tune your mind in terms of how you're going to think. So in terms of this, you're going to consider the fair value adjustments which are given in the additional information. And I would advise your focus in terms of part number 3 would be that there is any upstream transaction for which the impact is taken in the analysis. So when you're going to take the third inputs, we're going to take care of the unrealized profit, which is also called a stock reserve, which is supposed to be upstream in nature. So when you do the analysis of equity, get this very clear. Your analysis will focus on 3 core areas. You'll first of all focus on the balance sheet of the subsidiary. That is other equity in the balance sheet. Your second focus would be the stock reserve in the additional information and the fair value adjustments. Both this will be given in the additional information, and this is the focus in the balance sheet. Do not proceed with the analysis unless your mind is tuned that I need to take care of these three things. Got it? Now, let's go back. I'm now going to focus on the balance sheet of the subsidiary company. As I look at the balance sheet of the subsidiary company, I can see in the balance sheet of the subsidiary company, there is an other equity, and this other equity is split in terms of two components. We're given there is other reserves, and I'm also given that there is retained earnings. So I've got other reserves and I've got retained earnings, which I need to analyze. This 10 lakh rupees and this 8 lakh 20 is to be divided between pre and post acquisition. So what I'm going to do at this stage, no hurry. Hurry can make curry. So what we're going to do at this particular stage, when you are looking at the analysis of the retained earnings, make a time scale. When you're looking at the analysis of the retained earnings or the other reserves, make a time scale. See what is the position at the beginning of the year, 1st April X1. What is the position at the end of the year, March X2. So we can see that in terms of retained earnings, it says retained earnings shows a credit balance of 3 lakh on 1st April, out of which a dividend of 10% is paid. So the balance at the beginning was supposed to be 3 lakhs. And I'm given the balance at the end of the year in terms of retained earnings is appearing at 820. So the balance at the end of the year is appearing at 820. So carefully note down that this is the balance on 1st April and this is the balance at the end of the year. But he's also telling you something more. He is telling you something more, that what happened to this balance of 3 lakh. The retained earnings shows a credit balance of 3 lakh, out of which it says a dividend of 10% is paid on 1st November. Now, we need to be careful. This 10% dividend is paid after the date of acquisition. Does that make a difference to me? Very much. Very much. I am given the date of acquisition is 1st October and the dividend is paid on 1st November, though of course it is paid at 10%. So 10% on the share capital of 20 lakh comes to 2 lakh. So out of this, you paid a 10% dividend on 20 lakh. So this is coming to a total of 1 lakh. Friends, my advice. In the outer column pre, I will write down 3 lakh. In the outer column, I will write down 3 lakh. Sir, why? Out of this 3 lakh rupees, 2 lakhs of dividend has been paid. So what is left over is just 1 lakh. Why are you putting 3 lakhs out here? I need this information for the purpose of calculating the net assets on the date of acquisition, which is 1st October. And on 1st October, is 3 lakhs available or is 1 lakh available? You tell me. Did you get my point?
3 lakhs.
I'm putting it again. Yes. So in this particular case, when you're calculating the information, I do calculate 1 lakh. I need 1 lakh because what is the profits earned during the year is 7.2. What is the profits earned during the year is 7.2. So the calculating the profit earned during the year, I need that 1 lakh, but in the outer column, I'm still going to record 3 lakhs on a safe side. Because once I'm going to get the pre-acquisition equity, it'll help me to calculate my goodwill. Since the dividend was paid after the acquisition date, I know in this particular case that the net assets on the acquisition date is based on 3 and not based on 1. I hope I'm clear with the picture, right? You got my point clear?
Yes.
Correct? Good. Now, this 7.2 lakhs is earned during the year, and as far as my date of acquisition is concerned, my date of acquisition is on 1st October, which is the middle of the year. So whatever is the profits earned during the year, this is going to be divided in the time ratio, that is 6 months, 6 months, 1:1. So this will be 7.2 divided in the time ratio, 3.6 and 3.6. And you can create a separate column, retained earnings out here. When you split this retained earnings, in that particular case, you can split it in the time ratio, but in the post column, remember to create a separate heading as well. So why? The reason for the why is that this particular post acquisition RE is going to be added in RE. The parent share in RE will be added to RE. The parent share in the other reserve will be added to other reserve. So get the practice of making separate columns for the post, not for the pre. Not for the pre. I just need a separate columns in terms of post. Did you get the analysis of retained earnings clear?
Yes, sir.
Super. Let's go ahead. Now we are going to go to the next item in the balance sheet, and the next item in the balance sheet is supposed to be other reserve, and this is appearing at 10 lakh. And it said in the additional information, assume the other reserves on March X2 is same on April X1. So I think I'll put it out here only. So let me just take the space out here, other reserves. Here again, when you take the other reserve, make a time scale as well. 1st April X1 and March X2. So we know that the position on 1st April and the position at the end of the year is same. The date of acquisition is middle of the year. Would you like to tell me how much is pre and how much is post? Can I say the entire 10 lakh becomes pre? There is nothing which is post in nature?
Yes, sir.
Wonderful. So this takes care of my analysis on the balance sheet front. 1/3 is done. So now this is 1/3 done. The balance sheet of the subsidiary, other equity analyzed in terms of what is RE and what is other reserve. Now let's go to the fair value adjustments. Now in terms of the fair value adjustments, we're given a couple of information. It says that fair value of the plant on October X1 is 20 lakhs and the depreciation rate is 10%. Now there is a good number of calculations required. So we need to go for the fair value adjustments now. So we need to consider the case of plant and machinery. I would say organize this also very well in a working note. So let me do one thing. Let me just organize the plant and machinery working note. If I look back the status, the fair value of the plant in the middle of the year is 20 lakhs and the depreciation is at the rate of 10%. Now this plant and machinery is appearing in the balance sheet at 1350. If your depreciation rate is 10%, then this 1350 represents 90%, provided the depreciation is WDV. Because if it's a strict line, then you can't say it represents 90%. So I'm assuming the depreciation rates are WDV based. So if this is 90%, what we can do some backward calculations. So let's make a time scale. This is April X1 and this is March X2. So I am given the status in this particular case. The status is that this value at the end of the year is 13.5 lakhs. And this represents 90%. If this represents 90%, we can get the value at the beginning of the year that is supposed to be 15 lakhs. Now, why did I do a backward calculations? Because we did a revaluation in the middle of the year. Since we did a revaluation in the middle of the year, I need to get the status of the book value in the middle of the year. So let's get first of all, what is the book value on the date of acquisition? That is 1st July. Sorry, 1st July, not 1st October. So we need the book value on the date of acquisition, that is 1st October. Can I say what will be the book value out of 15 lakhs? You will take a depreciation 10% for a period of 6 months. Because
25.
I need to consider only 6 months depreciation up to the date of acquisition. That's right, 1425. Now it says this asset is taken at a revalued figure. What was the revalued figure? This machinery had a fair value of 20 lakhs in the middle of the year. So this is taken at 20 lakh. So what is the gain on revaluation? I guess 5.75 lakhs.
Yes, sir.
Correct. So this is how we're going to compute the fair value gain, and this is going to be taken as a part of the pre-acquisition profits. As soon as you consider the fair value adjustments, you need to immediately recall that there is a need for additional depreciations as well. So immediately we'll also go for additional depreciations as well. So let's see how we're going to consider the impact of additional depreciation. Let me now ask you a very simple question at this particular stage and vouch me. Can I say for the period of first 6 months, you took a depreciation on 15 lakhs and it should have been taken on 15 lakhs only? There's no problem. But can I say in the next 6 months, I should have taken a depreciation on 20 lakhs, but I took it on 15 lakhs. That means I should have taken a depreciation on 20, but I took a depreciation on 15. So am I supposed to take a 10% depreciation for a period of 6 months on this? That is additional depreciation. So you need to see that you've taken a depreciation on 15, but you should have taken a depreciation on 20 for 6 months. What is the additional depreciation? 25,000. Is it coming to 25, I guess?
Yes, sir.
Correct. So we take that additional depreciation as a reduction in the post-acquisition from the retained earnings. Wow. So my fair value adjustments are not done. I'm still on the fair value adjustments because there are more adjustments given in the question. Then he says, following are the increases in terms of fair value compared to the book value. So trades payable increase, land building increase, inventories increased. So let's add on more space. Let's add on more space to the fair value adjustments. Analysis of equity extended. So we are extending the analysis of equity, and this is pre and this is post. So continuing with the fair value adjustments further, there are increase in land and building. There is increase in inventory. And there is increase in the trades payable as well. And everything is going to be pre. But I'm not given any depreciation rates for the building. I can't consider any additional depreciation impacts as well. And nothing can be taken for inventories and trades payable. So let's see what is the fair value changes. Land building is 10 lakh and inventory is 150. So this is 10 lakhs and this is 1.5 lakh. Can I say increase in the fair value of assets is a gain, but increase in the fair value of liability is a loss? So liability is gone down, gone up by 1 lakh. So this 1 lakh rupees is taken in the brackets. That is a fair value loss. My second block of adjustments done. Can you see I'm tuning your mind to the adjustments in a very sequential manner? You focus on the balance sheet of the subsidiary and do the analysis by making your time scales. And then you go to the additional information, focus on the fair value adjustments. And then comes my input in terms of the third adjustments, that is upstream transaction stock reserve. Let's see if there is any upstream transactions in stock reserve. I don't think so. We are given any stock reserve or any intercompany eliminations, etc. So this is done. So now we can comfortably consider the sum total of the pre and the post acquisition movements. You must try this entire analysis with your hand today itself. Though I'll be quickly giving you a recap of this particular entire analysis in the next class as well, because I need to add more thing. The moment in this particular question the NCI gets added, it's going to get a wow factor. So let's see what is the pre and the post total.
32 lakhs 85,000.
Wonderful. 32 lakh 85. 3285, right?
Yes, sir.
Okay. And the post, beta?
335.
3 lakh 35.
335,000.
Sir?
Yes, sir. 3,35,000.
3,35,000 is the post acquisition as well. This is my step number 2A, which is done. I'll just like to key highlight some inputs again to get this very clear at the back of your minds. I just want to come back one on agenda again. This is the first question where we're looking at the analysis, and I'm putting your focus very clear. As I promised, I'll give you those extra choco chips and make that 7-step model rerunning again later, maybe after one more class. So in this particular case, what we're looking at is, when you're looking at the analysis, get into 3 parts. Your focus number 1 is going to be that you need to look into the balance sheet of the subsidiary, look at the RE and the other reserves, and do the analysis. Now, what is the main caution to be taken? In terms of retained earnings, when a company paid a dividends, what is left over is 1 lakh, but in the outer column, I did not write 1 lakh. I need 1 lakh because if I want to calculate what is the post-acquisition earnings, I need to compare 1 lakh and 8.2. But in the outer column, I wrote down 3. Reason: because I am doing this analysis for the purpose of goodwill and I need the net assets on the date of acquisition. The dividend is paid on 1st November. So in this particular case, since I need the position on 1st October, I will not take in the outer column 1 lakh, but I'm going to consider 3 lakh. So this is what is another important agenda to watch. The fair value adjustments to be taken, we made a separate working note, make a time scales for everything. When you do the analysis of the RE and other reserve, time scale, fair value adjustments, time scale, and remember to take additional depreciations as well. And then we took the other fair value adjustments, and the third focus was in terms of getting the stock reserve, which is upstream in nature. It was not there. Then we come to the step number 2B. And now in terms of step number 2B, we need to just add the equity share capital and the pre-acquisition equity in step number 2. So we will add the equity share capital because we need the net assets at this stage. And we decided that the net assets is going to be a sum total of the equity share capital plus the pre-acquisition other equity in this case. So let's see what is the amount of share capital in the balance sheet of the subsidiary. The equity share capital is appearing to the extent of 20 lakhs. So this is appearing to the extent of 20 lakhs, and as far as other equity is concerned, this is 32.85 lakhs. And remember, this is including that 3 lakh rupees, which is not yet available, because this amount is including before subtracting the dividend. This is the net assets as on the date of acquisition. Remember, this is the net assets on the date of acquisition, which is still available on the date of acquisition. Can I ask you a simple little question at this stage? Though it is not applicable in this question, but let me take a risk. If you were to calculate your NCI at Pasna, will you take 3285 or will you take something else? So don't we take the impact of profit during the year in the date of acquisition? Won't we take the impact of profit during the year in the date of acquisition? We've already taken the impact of during the year. You've divided the profits in the time ratio. So that's impact is taken.
So proportionate share लेते थे.
Now, my question, beta, is that when you're going to take NCI, are you going to take 3285 into NCI share or something else?
So 3285 का NCI.
No. That's the reason I asked. If you're going to consider NCI at Pasna, I will take 32.85 minus 2 lakh dividend and then take NCI share. Why? Because I need NCI on balance sheet date. Did you get my point?
Yes, sir. Got it.
Good. Don't worry, we'll be coming to that issue as well. It was a little early to push that point, but I thought it's the right time to put it. Which means I think let it be. We'll talk of this in the next class, not today. Zyada ho jayega. So this is 52.85 lakhs. This is going to be 52.85 lakhs. But I can definitely advise one thing. Let me put that as well. My advice would be that since you have taken 3 lakhs in the outer column, it would be great that you organize the net assets two figures. You organize the net assets of 32.85, which was there on the date of acquisition, and you reduce that 2 lakhs, which is the dividends paid, and organize what is still available on the balance sheet date. It will give us a better inputs to go further. We'll talk of this later more, no worries on that. So if you make a balance sheet on the date of acquisition, it will include a profit during the year. No, if you're making a balance sheet on the date of acquisition, that means there is no post-acquisition earnings. Why would you consider a profit for the year in that case? I think better you're getting mixed up on that. Okay, got it. Till now we have done questions which were on the acquisition date. Now this is a question which is a shift. You're making it at a later date. Okay. My step number 2 is done. I am not taking this further. As I said, I'm not interested to finish the question. I am going to consolidate this analysis again to give you the inputs. But my request, earnest request, is that please do a revision of all the inputs I've done. If the need be, watch this class again and make your inputs and get ready, because my level of the questions which I'm going to do in the next class will certainly push up. Because in this case, we've introduced the dividends, and dividends can create some tricky situations in the calculations, and there are more adjustments to come. I'll add on some more adjustments and I'll consolidate this input also in the next class with you. So that's all for the day. I'm sure you must be feeling heavy. If you're feeling heavy, that's perfectly okay. You should feel a bit heavy as well. But as I said, as I requested, please consolidate and revise every bit of it before you come to the next class. Please make your consolidated revisions, not for the earlier 2 classes. Even if this class is revised properly, it'll help me a lot. So very heavy, that's why my mind is going clouded. That's perfectly okay. I understand that. Okay,
Thank you,
let
sir.
me see. Hanji beta.
The way you teach, it makes it really very easy for us to get that things.
Thank you indeed. That's very encouraging for me, I guess. I feel blessed for that beta. But of course, your own hard efforts are also very important. I know many of you study well as well. That comes up when I see the answers as well. So God bless all of you.
Thank
Sir,
you.
it was really a privilege for us to teach from you. You make each and every concept very much clear and simple for us to understand. Thank you very much. Thank you, Jenny. Thank you indeed. That's really nice of you, sweet of you. Thank you very much indeed. Haji beta, you were saying something, I cut your voice. Right, so any questions on your end? Otherwise, I think that's all for the day. I'm going to join you in the next class with some more interesting inputs coming on Console for the Good. Right, thank you, beta.
Thank you.
Haji, sir, I have a question. Is there any change in Index 19 since the inception of Index? It's difficult to tell you better the track of since Index there has been changes or not, because there are a lot of changes happened in terms of Index. I can't really remember immediately at this point that what has been a specific change since the inception of Index in Index 19, but I'm sure there has been some changes on the disclosure fronts, I guess, on the remeasurement gain or loss, if I rightly remember. But I still need to check it up before I commit anything on that.
So that is because I was asking, because you have videos on YouTube regarding Index 19, and I was confused regarding
From the
Index 19.
examination point of view, you can watch them, should not be a problem.
Okay, sir. So because I'm a huge fan of your teachings.
Thank you
Thank
so
you,
much
sir.
indeed. That means a lot. Right. Thank you very much. Haji, thank you.